Let's check out some of today's notable analyst calls and recommendations. Our first is on Vermilion Energy. Desjardins is upgrading the stock to a buy from hold. You can see the shares have been under pressure over the past year. The price target here is $24.50. This follows the company's earnings results, which were poorly received by the market. However, the analyst believes Vermilion's valuation is too compelling to ignore and sees clear signs of increased capital returns through buybacks, probably in the first quarter of 2024. And Desjardins also is looking for more upside through the potential elimination of European Union windfall energy taxes next year. Our second notable call is on Nutrien, the fertilizer giant, and it's a different story here. JP Morgan is downgrading Nutrien to neutral from overweight with a price target of $58 US, down from $70. We're showing the Canadian price there, I believe. The analyst, that is, I'm told now, the US price. The analyst says Nutrien's EBITDA continues to make its way lower as a base case from the peaks reached during the early days of the Russia and Ukraine conflict. The potash market is loose, according to the analyst, and potash tons are being added by producers in Laos, Russia, and Belarus. Warren Buffett, probably the world's most famous investor. His Berkshire Hathaway reported results over the weekend and revealed that its cash pile has topped a new record of more than $157 billion US. We're joined by Matthew Palazzola from Bloomberg Intelligence. Matthew, thanks very much for coming on the show. Could you start off by talking about the difference between Berkshire Hathaway's net loss of almost $13 billion and the operating company's performance?
Yeah, of course. It's honestly more of an accounting convention than an actual realized loss. So what they have to do is they have to run the change in their investment portfolio through their income statement. And what happened is they own a lot of Apple shares. Apple was down a lot in the quarter, so that led to the net loss. But if you look at the operating company's earnings, they were up almost 60% to a record of about $10.5 billion.
Okay, so the actual, it was wonderful world of accountancy. And of course, Apple has come well off its highs of the year, rallying a little bit over the past few sessions. Gavin, I think you have a question?
Yes, Matthew, Gavin Graham here. With that almost $160 billion on the balance sheet, and I think Charlie Munger was saying that there was maybe one more big acquisition that Berkshire could undertake in the near future. Did they give any indication at all of which areas they might be looking at?
No, I was thinking energy, right? But with their moves in Oxy, in their annual meeting, they said they weren't going to buy the whole company. They've also been paring their holdings in Chevron. So I don't know. Charlie Munger gave a recent interview where he had actually said competition's driving up the prices of a lot of deals. And the other thing, with the rise in interest rates, holding cash is not as bad as it was. They used to be generating $50 million in interest income. Now they're going to generate over $5 billion.
So much. Sorry, Berkshire holding nearly $160 billion US in cash. It is interesting, though. I mean, there's an opportunity cost. They could be buying companies here.
Yeah, I mean, they haven't been sitting on their hands. They bought Allegheny for about $13 billion. That brought them an extra bit of reinsurance, which has been a great business this year. They have a problem I wish I had. They're generating more cash than they can actually spend. They're not sitting on their hands. They're not buying back shares because the stock's been at an all-time high. So they're kind of between a rock and a hard place on what to do with the money.
And fascinating as well, we just have been through a tech boom, an AI boom, and that is the environment which in the past we've seen Berkshire Hathaway tend to underperform.
Yeah, I mean, look, I think people think of it as a proxy for the economy, and when you're in a risk-on environment, this is probably a stock that maybe someone doesn't want to own. I would disagree with that. I think this company has really diverse earnings power. I mean, if you look at Apple, is the fates of Apple do tend to move the book value of this company. It was, by the way, those unrealized movements in the portfolio, those were about 30 billion and 25 billion in the first 2 quarters, and that was driven by Apple shares. So the fact that it hit down in the third quarter, not that much of a surprise, but they are, exposed to tech overall.
Matthew, thank you very much indeed. That's Matthew Palazzola joining us. He's with Bloomberg Intelligence.
Well, it looks like the holidays may be a challenging period for eBay. It just reported its third quarter results, but also gave a forecast for the fourth quarter that appears to be weighing on the stock in after-hours action. And we're going to bring in Nicholas Jones. He's an equity research analyst with Citizens JMP Securities for his take on what we're seeing with eBay. Nicholas, do you think that the moves that we're seeing in after-hours down about 4%, I believe, has to do with that fourth quarter revenue outlook?
Definitely. I think so. Through this earnings cycle so far, we've heard from Amazon, we've heard from Etsy, we've heard from other retailers that consumers are starting to be a little more discerning in their discretionary spend, looking for more deals. So, heading into the quarter, I think the question for eBay and pretty much anyone exposed to consumer retail, particularly discretionary retail, is how strong will 4Q guidance look? And we're seeing with eBay's guidance, it's a little below what the street was looking for.
For the third quarter, though, meeting expectations, do you think the expectations were just at a level that they were able to clear? Was there anything, in term from that we should read into?
Yeah, the buy side and investors are using a lot of third-party data, credit card data, web traffic data, app data to really track companies intra-quarter. So I think heading into the quarter, eBay was right down the fairway, largely in line with what people were expecting. Margins came in line with what people are expecting. So really, as we get to this point in the earnings cycle, the attention really gets into what is guidance going to be? And what does that indicate what we might be looking at as we head into 2024? Which is more opaque than even what's in store for the next 2 months.
Oh, that's really interesting. So by the time the company is actually reporting, a company like eBay, it's not really much of a surprise because of all the data that you can look at. You track revenue per visit, one of the elements that you look at. Can you give us a sense of how that's changed over time?
Yeah, so eBay's been changing their strategy and really focusing in on focused categories like auto parts, and they're authenticating luxury items. So as they focus in on higher value buyers, they're essentially shedding traffic that is, I guess, ostensibly less valuable or less prone to having repeat rate. So we're watching eBay work through kind of a strategy shift where they're really going to get deeper with certain customers. They're ultimately higher value in the end. So that's what we're watching today. And, this is a tough environment to work through that type of shift.
Yeah, that authentication of clothing, that seemed really interesting. Acquiring that company, is it Certilogo? Is that how you say it? Yeah, that sounded like an interesting element to add in because, you want to be able to have that trust that if you are spending a considerable amount or really anything, that that product that you're buying is actually the brand or what have you that the person is saying that it is.
Yeah, absolutely. It's a big pain point, particularly online. If you're going to buy a luxury item, you want to make sure it's real. Particularly if it's going to be a kind of a higher consideration or ultimately a higher cost. So that's a big problem within the luxury market, whether it be watches, handbags, clothing, you can kind of name it across the luxury spectrum. Authentication is a big deal. As they focus on that authentication, as an investment makes sense for eBay. We think that makes a lot of sense as they go forward and focus on these categories.
I should also just read out the gross merchandise value that's expected for the fourth quarter, coming in at a range of 17.9 billion to 18.3 billion, and the estimate had been 18.4, so also lower than the expectation, although I guess that would make sense if you're expecting revenue to come in lower as well, Nicholas.
Yeah, absolutely. This kind of goes back to what we talked to at the beginning of the segment here is consumers are getting a lot more discerning. They're prioritizing staples. We can see that delinquencies are going up with auto loans, with consumer loans. The consumer is under pressure. So we think this guidance really is in line with what we've been hearing, across the street. And really what investors are looking for is what are the right stocks to hold, and are there stocks that can are they immune to what's happening in the fourth quarter here? And we can see with eBay, they're kind of feeling the same pressure we're hearing from a lot of other folks.
Yeah, so is this just a tough time across this sort of space right now that eBay just needs to get through?
Yeah, we're running into a tough environment heading into 2024. Consumers are running out of money. Saving rates are going down. Home affordability is very difficult. Auto affordability is very difficult. Credit card debt is increasing. So all of these kind of macro indicators would suggest the consumer is under pressure, and they're going to have to be a lot more discerning as to where they want to spend their money. And generally, home and auto and staples come first.
And in the meantime, eBay is doing some investment in artificial intelligence. Can you give us just a bit of a sense of what they're doing there?
Yeah, it's really early days to kind of know what this is going to unfold into, but it's really exciting. It could go as far as helping sellers properly list their listings and describe them properly so they're easier to find. That could then enable better search and discovery for users like you or me. It could help with their advertising. It could help internally with their developers as they launch more technology updates to the platform. I mean, the opportunities are really endless in AI, particularly generative AI. So really too early to tell, but really exciting stuff for the company.
Nicholas, great to get your insight into what the company is facing and also the context on the breaking results. Really appreciate it. That was Nicholas Jones. He's an equity research analyst with Citizens JMP Securities on eBay's latest results and also its outlook on the fourth quarter, which appears to be what is putting some pressure on the stock in after hours.
Well, this is the time of year when the finance minister typically provides an update on the economic and fiscal outlook. One of the messages being sent to Ottawa is to be mindful of more spending. The Business Council of Canada recently shared that view, and even the Bank of Canada Governor Tiff Macklem recently urged lawmakers to consider the inflationary consequences of spending as the central bank tries to cool down prices. Speaking of a cool down, higher interest rates are playing a role in deepening the deficit picture. According to the Parliamentary Budget Office, Canada's spending watchdog recently projected the deficit would be about $6 billion greater than what the government had projected in April, now clocking in at more than $64 billion. The PBO, Yves Giroux, joins us now to talk a little bit more about the fiscal story. Nice to see you. Thanks for your time as always.
A pleasure.
And I guess, as I alluded to, when you made this announcement recently, it is the cooling effect from higher interest rates that does play some of the role in this larger fiscal deficit that we're looking at right now?
It is, and it's also an increase in interest rates that we have all seen. That's increasing the cost of servicing the increasing federal debt. So debt servicing costs have gone up significantly over the last couple of years and will continue to go up until there's a return to more or lower interest rates when the Bank of Canada starts lowering these rates again, expected to start happening sometime in 2024, probably after the first quarter. So as we see a small, humble, slow decline in interest rates, debt servicing costs at the federal level should continue to increase because the deficit will add to the debt, but at a lower pace than what we have seen recently. And of course, economic, sorry, go ahead.
No, sorry, finish your thought, I apologize.
And of course, as we see an economic slowdown, the increase in federal revenues will not be at the same pace as we have seen recently.
We talk a lot about where the economy lands, what kind of economic picture we're going to look at. Are you able to project, if you're seeing what they might call a so-called soft landing or a mild recession or a deeper recession? Are you able to quantify in all of these economic scenarios how the fiscal picture ultimately plays out?
Well, based on what we have seen so far, our most likely scenario calls for a so-called soft landing. So we project growth to decrease. Well, it's decreased significantly already. So compared to 2022, in 2023, it should be overall, as for the year as a whole, it should be economic growth of 1.2%, decreasing to 0.7% for the whole of 2024, with economic stagnation this quarter and for the first half probably of 2024. So probably what one would call a soft landing, which is the most likely scenario. It doesn't mean that the technical recession is completely out of the question. It's still possible, especially if consumers and businesses react more strongly than anticipated to the increase in interest rates. Well, and that will have an impact on the federal finances.
You know, staying on that subject, sometimes you hear economists talk about a situation where you've got stagflation, where things are cooling down, but the inflationary pressures persist. Obviously, many people know that right now inflation is not at the levels that typically a central bank like ours would like to see, their target levels. And I mentioned the fact that the Bank of Canada governor himself had mentioned to lawmakers that there are inflationary ramifications that can come from spending. Are you able to quantify that, how much inflationary pressure comes from whatever the spending bill in Ottawa ends up looking like?
It's very difficult to quantify that for two reasons. One, what's the counterfactual? So what do you assess this against? What is normal spending these days? That's difficult to assess. And two, there's a lot of promises that have yet to be fulfilled. Not necessarily a lot of promises, but a few expensive promises. If one thinks about a national pharma care program, that would add significantly to federal spending. There's discussions about finding $4 billion in savings at the federal level. But whether that will be pure savings or whether that will be recycled through higher spending in other areas is still a question that has no answer. So whenever the minister tables her finance or her fall update, we'll have more answers to whether or not the federal spending is adding to the inflation. But it's difficult to quantify the extent to which federal spending adds to the inflation, the overall headline numbers.
And I guess another complicating factor is when there's already a lot of spending and then there's other considerations that come onto the table. Every day we're watching some of the geopolitical headlines right now. That's something else that has to get navigated.
Totally. But so far, what we are anticipating is a return to inflation numbers that are more familiar to Canadians, around 2%, especially in the second half of 2024. That means prices will continue to increase, but at a lower pace than what we have seen. And that may be why people are confusing stagflation with inflation returning to its normal level. Some people are expecting that inflation returning to what we are used to means prices returning to what they were before the bout of inflation we saw. And there's a big difference between price levels and the rhythm at which prices increase.
Just a final question as we await the economic and fiscal outlook. The question of what we can afford obviously comes up anytime we're seeing budget planning, and especially when we're running deficits as we are right now. You highlighted the higher interest rate reality, which means much higher servicing costs for debt for the government itself. If the picture plays out the way the PBO now sees it, is that something that Canada can afford, or can we afford this kind of deficit picture longer term?
Well, it's something that has to be defined as what you mean by affordability, and we've defined it as a debt to GDP ratio that doesn't increase forever. So you look at a snapshot now, and you look at what the status quo policies would lead to in terms of debt to GDP ratio, in 75 years. And if you end the period at a level that is at or below the current debt to GDP ratio, finances are affordable. So in that perspective, yes, federal finances are affordable in the current status quo policies, but status quo policies by definition don't stay like that, because politicians get elected to implement their policy statements, their platforms. So whether current policies are affordable. Yes, they are, but it doesn't mean that the government can do whatever it wants without jeopardizing that sustainability in the very long term.
All right. Well, obviously, we'll continue to watch the fiscal story. Yves Giroux, appreciate your time. Thanks very much.
Always a pleasure.
Yves Giroux is the Parliamentary Budget Officer.
Welcome back. Quebec-based renewable energy producer Boralex reported its latest financial results this morning. And although it did beat estimates on revenue, the company did miss on earnings. It also saw net income land slightly to the negative. Despite pressures being faced by the renewables industry, Boralex's CEO is confident that projects under construction in Quebec, Ontario, and Europe will continue to add to their returns. For more, we're now joined by Patrick DeCostra. He's president and CEO of Boralex. Thanks for joining us, Patrick. First of all, what are some of the pressures, if you could tell us, that the renewables industry is facing?
Good afternoon, and thank you for having me. Essentially, the pressure are coming from increased cost of equipment and increased cost of capital. So this is the main issue that we have, but we have been able to protect us by transferring partly or totally this increase of cost to the off-taker, the buyer of the electricity.
How have you seen project returns and investment hurdle rates adapted to the current environment?
We are hunting for low teens return, and previously we were saying we were looking to 8 to 10%. So no, it's increased since many months now, and we have been able to, as I was mentioning, adapt financing, adapt size of equipment sometimes, adapt also contract. That's what we have done in the UK, for example, when we have won a very high price contract for 15 years in Scotland. And this bring the return of the project more low to mid-teens compared to previously.
You know, with the prices of power purchase agreements on the rise, how does Boralex intend to maintain competitiveness without compromising on that profitability?
Yeah, essentially, we have a big organic pipelines. We have a pipeline of roughly 6.4 gigawatt. We are operating 3 gigawatt, and so this organic pipeline, we have the time to play on many parameters, typically the equipment, the optimization of the project themselves, the optimization of the way we supply the equipment, and finally the financing and the operation costs. So we have many levers to adapt, and also there is a demand for electricity from corporation and electricity from, say, utilities in all the market where we are, where the demand is very high compared to some years ago. So the price is also going up. Typically in France, price has gone up by 40%, the price that we can get through corporate PPA or PPA power purchase agreement with the local utility. Is the same situation in the UK, is the same situation in the US too. So we're waiting for results here in Quebec, but the demand in each market in Quebec and Ontario also is very high, so our product will be more valuable in the future.
Wow, so demand is rising. What's driving it?
Essentially the fact that the only way to reduce greenhouse gas emission in advanced economy is it's electrifying transport, electrifying heating, electrifying industrial process. And this is typically the plan of Hydro-Québec that has been launched last week, which shows that they have to increase by more than 100 terawatt hour, meaning to build a half Hydro-Québec in the next 15 years, and meaning what is possible to deploy is essentially renewable energy, specifically wind, solar, and maybe some hydro. And so the demand is going up because of that and because the will of fighting climate change.
You know, we don't have a lot of time left, but just quickly, funding growth in this sector has been a concern. How do you plan to finance your growth pipeline?
essentially, Boralex, we have liquidity produced by our operations. We have a very reasonable payout ratio around 40%. So we are keeping some liquidity from the operation. We are a non-very leveraged, not too much leverage company. So we have some room to leverage a little bit more and have access to debt. There is a possibility also to do what we have done in the past, means assets recycling, so selling some assets or part of the assets to financial partners who are bringing money in the company to continue to develop. So we have many possibilities. And last but not least, not with today's price, but last but not least, we will one day issue equity, but we don't need to issue equity for the next 18 months.
Okay. Thank you so much for all your time and insights today. That was Patrick DeCostra, President and CEO of Boralex.
It's time for On the Radar. We ask an investing professional what he or she is looking at in today's markets. We're back with Carl Berger from Seidel Asset Management. Carl doesn't expect a recession, and he's leaning towards cyclical sectors in investor portfolios. I mean, without getting into definitions, economic definitions, but you're not looking at sustained lower GDP.
Well, so that's where I might actually shift it around a bit,
Okay.
Andy. I could imagine lower GDP, certainly lower than it has been.
But declining, though.
And to me, whether it's a recession or not, whether it's a technical definition of a recession, whether we have minus 0.5% growth or plus 0.5% growth, it's a low growth environment.
Okay.
I don't think we expect a significant recession at this point. Employment demands are too strong still. Housing is too strong. It doesn't look like either of our North American economies are on a trajectory that would lead to a significant recession. But we're in a very, very slow growth period, especially in Canada right now, and have been for arguably a couple of quarters. So whether it's a technical recession or not doesn't really bother me one way or the other. You'd mentioned that our portfolios are slightly tilted towards cyclical stocks at this point, and that's as much a function of the valuations that were available at the end of 2022 when markets performed as poorly as they did, and some of the IT stocks, some of the industrial stocks were really suffered during 2022. That was a great opportunity to add them. Those stocks haven't necessarily performed brilliantly through 2023 because we've been sitting in a uncertain growth environment with continued monetary policy tightening. But I think as we get through that period, and you'll gather from my comments so far that I think we're through it, we should be in a place where we can look at the next 5 or 10 years as maybe not the start of the next raging bull market right now, but certainly we're starting from a point where equity valuations in the majority of the sectors that we look at are reasonable. They're not cheap, but they're certainly not expensive. Multiples are not challenging in Europe, in parts of Asia, in Canada, in parts of the U.S. They're not challenging. In the tech sector, yeah, they're still high and probably always will be. But so if you look at where we're sitting right now, and especially with the backdrop of the fixed income that we talked about in the first segment, there's a reasonable expectation for pretty solid returns from both equity and fixed income portfolios over the next few years, and I'd argue from a decent starting point here for equities that could extend out. Doesn't mean it's going to be a straight line, and it doesn't mean it's going to be smooth. And there is all kinds of geopolitical risk that investors still need to be aware of at this point, because it's impossible to tell what that path could be. But it's also really, really difficult to manage to a geopolitical risk that hopefully has a tiny percentage probability of actually happening. If it does, it's going to be horrific from so many different perspectives. It's really difficult to manage to that possibility in an equity portfolio.
Sorry, Carl, what would be horrific again?
Oh, if tensions in the Middle East escalated dramatically, for example. So we get questions all the time, like, what if China invades Taiwan? Why are you invested? Because there's a good chance that they'll do that. Well, it's probably not a good chance that they're going to do that. It's a possibility. It's what you might refer to as a tail risk event, a very small probability, but that would have very, very major consequences if it happened. It's really difficult to manage a portfolio to cover those slim possibilities and to still be invested productively.
Now, just on cyclicals, are you talking about classic cyclical stocks like chemicals and steel, for example?
Yeah, so our highest weights in our core models right now are financials, information technology, and industrials. And all three of those categories would fall into the cyclical side of things. Consumer discretionary would be the fourth biggest weight for us across most of our mandates. And it doesn't mean that we're risk on, this is the start of the next raging bull market. It simply means that there's value. We think there's value in some of those stocks and some of those sectors, and we're comfortable to have that kind of exposure based on the economic backdrop that we think is unfolding.